Right now, millions of dollars are being made and lost in the stock market, and most people have no idea how it actually works. Let's fix that in the next few minutes. A stock represents partial ownership in a company, not just a piece of paper or a digital number. When you buy a share of Apple, you own a tiny fraction of Apple itself. The brand, the products, the profits, and even the risks. The more shares you own, the larger your stake. If Apple earns profits or grows in value, your slice becomes worth more. If it struggles, your slice shrinks. The stock market is a system that allows investors to buy and sell these small pieces of ownership. It's not one single place, it's a network of exchanges around the world. The two biggest in the US are the New York Stock Exchange and the NASDAQ. Each exchange works like an auction. Buyers make bids, sellers set prices, and computers match them in seconds. That constant buying and selling is what makes the market move. Stock prices rise and fall based on supply and demand, but also on expectations. If investors believe a company will perform well, demand increases and the price climbs. If bad news hits, like lower profits or a leadership scandal, confidence drops, and so does the price. Emotions play a big role too. Fear and greed move the market just as much as facts. Companies don't sell stock just for fun. They do it to raise money. When a company goes public, it holds an IPO, or initial public offering. This allows it to sell part of itself to investors in exchange for cash it can use to expand, hire employees, or pay off debt. In return, investors hope the company succeeds, making their shares more valuable over time. There are two main ways to earn from stocks. 1. Capital gains, buying low and selling high. 2. Dividends, a company's way of sharing profits with its shareholders. But the market can also fall. Investors who panic and sell too soon can lock in losses, while patient long-term investors often see growth over time. The stock market rewards knowledge, patience, and emotional control. Over the short term, it's unpredictable. Prices bounce up and down like waves. But over the long term, the trend has almost always been upward. That's why most retirement plans, like 401ks, use the stock market. It's risky day to day, but powerful over time. The stock market doesn't just affect investors, it affects everyone. It influences job growth, interest rates, and even the strength of your country's economy. When the market is healthy, companies grow. When it crashes, people lose jobs, savings, and confidence. So the stock market isn't a mysterious casino, it's a mirror of human behavior, confidence, and innovation. It rewards those who learn how it works, not those who treat it like a game. If you could own one share of any company, which one would you pick? And why? Comment below. And if this helped you understand the market, hit like and subscribe for more smart money explainers.